And with that, I will now introduce Dr. Xiying Liu, CEO of Mountain Crest Acquisition Corp. Xiying.
Thank you, and welcome everyone. At Mountain Crest, a key investment objective of ours was to bring to the public markets a brand with global market opportunities. And we are doing just that with Playboy, one of the world's most iconic brands, which we believe with this expert team and committed capital can further unlock a highly relevant commerce-driven company with opportunities in several key pillars, which will be discussed today. We have about $58 million in the Mountain Crest Trust account, and we have raised $50 million in committed PIPE investments. Upon closing, the combined company will have an anticipated enterprise value of approximately $413 million and have over $100 million of unrestricted cash on the balance sheet. I'll now turn the call over to the Playboy CEO, Ben Cohen, who will go through Playboy's recent evolution, its unique positioning as a global consumer lifestyle platform, and his strategy for future growth. Ben?
Great, thanks, Xiying. Good morning, everyone, or good afternoon. Before we get started, I just want to give an update on where we are in our process of merging with Mountain Crest Acquisition Corp, or MCAC. On February 9th, we will be having our shareholder vote, and should we be successful, we plan on emerging as a public company trading under the ticker PLBY shortly thereafter. Just a little bit on the capital structure before we get started, and then I want to talk about my background and why Playboy is so exciting. Our capital structure, if we're successful in retaining the money in trust, we expect to have approximately 37 million shares outstanding. As Xiying said, over $100 million of unrestricted cash on our balance sheet to accelerate our growth, both organically and inorganically, and approximately $40 million of net debt, or 1x 2021 adjusted EBITDA. Really quickly on my background, I've spent the past 25 years in private equity. First at a firm in New York called Angelo Gordon, and then in 2004, I left and started a firm with two partners called Rizvi Traverse. At Rizvi, we did two things. We invested in some of the biggest tech companies. We took large pre-IPO stakes. In Twitter, we were the largest investor when it went public. We invested in Facebook, Snapchat, Square, SpaceX, Instacart, Uber, etc. And we also bought some of the most iconic entertainment assets, ICM, one of the largest talent agencies, and Summit Entertainment, the film studio behind the Twilight franchise. Playboy was actually a company I had taken private in 2011 and partnered with Hugh Hefner, but did not step into the full-time role as CEO until 2017. Playboy is such a unique asset. You can't imagine the scale and the infrastructure that we have on a global basis. And my vision when I took over as CEO was to actually continue what I had done in private equity, but to do it in a public company, holding company format. And so in 2017, my goal was to turn around the brand, really revitalize what was one of the largest brands in the world, with the potential to reemerge as a public company, giving us the most flexible capital structure to explore inorganic growth. We've seen unbelievable growth over the last 3 years in the business. Our top line numbers do not tell the full story. Our future business, really consumer products, has continued to grow every year while we have wound down our legacy media businesses. We no longer produce a domestic magazine, and over the last 3 years, we've been really winding down what has traditionally been the legacy business. Just a little bit on Playboy and why I think it's the perfect franchise asset to build the rest of the company on. And that's really our signal with emerging as PLBY Group. Playboy's huge. Consumers spend today in excess of $3 billion buying our products in over 180 countries. We're well on our path to $100 million of organic EBITDA by 2025. Actually, in 2020, even in the face of COVID, we saw revenue up 75% and adjusted EBITDA up over 112%. We're organized around 4 key categories: sexual wellness, style and apparel, beauty and grooming, and gaming and lifestyle. These categories are huge, they're multinational, and they're growing everywhere in the world. We will have $100 million to accelerate our growth both organically and inorganically going forward. The last 3 years, the company has been completely cash strapped, and so all of the growth that we have achieved as a management team has been done with no cash. And I will tell you, my management team is very excited to make very smart capital bets moving forward. We have very little CapEx as a company, and so when you look at our EBITDA to free cash flow conversion, it's very high. Next year or this year, we're projecting less than $1 million of CapEx, and we have over $180 million in NOLs to not only shelter our organic growth, but also our inorganic growth. Really quickly, going back to those 37 million shares that will be outstanding pro forma for the deal. Existing Playboy shareholders in management, which owns a significant portion of it, will own approximately 66% of the company on a pro forma basis. And we are all signed 12-month lockups. Mountain Crest was truly unique. We did not look at this transaction as a sale transaction, but a capital raise transaction, really to accelerate that growth I'm talking about. Mountain Crest has no warrants outstanding. It only has a 1/10 of a right per share, and those rights automatically convert into common stock. And so something that was extremely important to myself as a large holder, as well as our existing shareholders, was taking as little dilution as possible, but giving us the capital to really take advantage of the opportunity in front of us. Playboy, as I said, is so unique in that the number of products this brand plays on and has played on through its 67-year history really gives us unlimited growth potential moving forward. Really quickly to recap our financials, last year we were projecting $137 million in revenue and $28 million in EBITDA. And as we said when we released our third quarter numbers, we expected to meet or beat that number, as the fourth quarter is traditionally our strongest quarter. And then this year, we're reaffirming our guidance of $167 million of revenue and approximately $40 million of EBITDA. And we believe as a team, we are well on our way organically to our 2025 projections of $296 million of revenue and $104 million of EBITDA. We also believe that we can accelerate our path to that, both organically as well as inorganically moving forward. Just really quickly summarizing some of the key stats. We have over 1 million active digital customers in the United States. We're one of the top 20 licensed brands in the world, actually number 17. Disney is number 1. We sell product in over 180 countries. We pretty much have 100% unaided awareness around the world. In China, we are one of the leading men's apparel brands. We have over 2,500 brick and mortar stores and over 1,000 e-com stores, and consumers spend in excess of $1 billion US in China buying our products. And what really is truly unique is that global audience that we have and that awareness, and that gives us the ability to sell products on a direct-to-consumer basis at a much reduced customer acquisition cost because of that large organic audience we have. Again, we're organized into 4 multinational, highly growth categories: sexual wellness, style and apparel, gaming and lifestyle, and beauty and grooming. Our revenue breaks down across those 4 categories in the following way. Sexual wellness, and these are 2020 numbers. Sexual wellness accounted for approximately $55 million of our revenue. Style and apparel, 74. Gaming and lifestyle, 3.5. And beauty and grooming, 2.9. Really quickly, and I think it's important to note how we monetize in each of these 4 categories. We monetize across 2 primary ways: on a direct-to-consumer basis and on a royalty or licensing basis. In the sexual wellness category, most of our revenue today is direct-to-consumer and owned and operated. In style and apparel, most of our revenue today is licensed, and that is a business that is largely international, although we have a very vibrant and growing domestic business in the style and apparel business. Gaming and lifestyle is, again, largely a licensed business and will continue to be a licensed business moving forward, because it doesn't make sense for us as a brand or a single brand to be licensed in all of the jurisdictions that are required. The one caveat to that is in social gaming and being able to create virtual worlds like on the Unreal platform, which is something we're exploring, is either a joint venture or an owned and operated platform. And then the last is beauty and grooming. This is a category today that is licensed, but is something that we are planning on operating ourselves moving forward. The revenue breaks down across these 2 primary ways. It's $68 million last year in direct sales or subscription business. We achieved an AOV in the sexual wellness commerce business of over $72 in the first half of 2020. And then on the royalty-based revenue, it was approximately $67 million. The royalty-based revenue is what gives us really unbelievable visibility moving forward in our business and emerging as a public company. Think about this as a quasi-SaaS business. We have over 400 million of forward-booked minimum guarantee cash flow. Now, there's a difference between the minimum guarantees that we receive on our contracts and what we actually recognize in revenue, which is the $67 million. And I'll talk more about that in a second. And then third-party retail sales is a small part of our business, but something that we will look at growing in the future. Just recapping our direct-to-consumer business, or direct sales and sub business for the first 9 months of 2020, we saw revenue accelerate from 5.4 million in 19 to over 46 million for the first 9 months. Our minimum guarantee or our licensing business is backed by $400 million of minimum guarantee contracted cash flow. This is highly visible. A lot of this revenue comes in 6 months in advance of actually the period in which we recognize revenue. Couple things on this. Most of our contracts have a minimum guarantee against a percentage of revenue. What you're seeing on this slide is only the minimum guarantee portion. You're not seeing the overages or the deals in which we have no minimum guarantees, but get a much higher percentage of revenue. That's really the delta between these numbers and the $67 million that you saw 2 slides earlier. The other thing to note on this analysis is when this analysis was prepared, when we went to raise the PIPE in early fall, this assumed that if a deal expired after we prepared this analysis, we took it to 0 moving forward. So there's no renewals in this analysis, even though our historical renewal rate is in excess of 95%. And so what you should see moving forward is these numbers will continue to grow moving forward, as licensing is a key part of our revenue stream moving forward and something that we anticipate can double moving forward or more than double moving forward, but it's not our business model by itself. Our revenue breaks down on a geographic basis, approximately 52% in North America and 40% in APAC. And I want to talk a little bit about the direct-to-consumer business and the licensing business on a geographic basis. Most of our business in North America is direct-to-consumer, and most of our business, almost all of our business in the APAC region, is on the licensing business. In North America, there are many opportunities to continue to expand the licensing business, specifically in gaming. But from a consumer product perspective around sexual wellness and around style and apparel, largely our streetwear business that has seen unbelievable growth over the last 3 years. Our partnerships with PacSun, Missguided, Supreme, to name a few. The PacSun and Missguided businesses have increased almost 15x over the last 2 years. And with our launch of Playboy Labs last year and our partnerships with Steve Aoki and others, we're seeing an unbelievable acceptance by the consumer for Playboy streetwear. That business we anticipate will continue to accelerate moving forward on a D2C basis, as we have really transitioned our business over the last few years from a pure licensing business and media to that of a consumer product business where we want to own that relationship with the consumer. We believe if we are successful in that, which we have seen early signs of, that we can continue to expand that D2C business in other parts of the world, and the next region would probably be APAC. We also recently launched a deal in India. We spent a lot of 2019 developing India as a market. The brand is loved there. We have pretty much 100% awareness. And we believe India going forward from a macro perspective could be an unbelievable growth driver for the business. Just recapping our recent results again, and these numbers are through September of 2020. Revenue increased from approximately 57 million to 101 million, EBITDA more than doubling from 9.5 to 22 million. And again, the fourth quarter is our strongest quarter. Our growth strategy moving forward to the $100 million of EBITDA is across all 4 categories. The sexual wellness category, which we believe is right down the middle of the fairway for us, using a golfing analogy, is growing everywhere in the world. It's a $240 billion category today on a global basis, projected to increase to $400 billion by 2024. Style and apparel, $50 million of growth moving forward. We believe this will be split between our direct-to-consumer business in the United States and other parts of the world, as well as increasing our licensing business, where we already have deals in hand such as a new recent kids deal that we signed in China for kids apparel for over $1 million a year moving forward in revenue. Tons of room in our gaming and lifestyle business moving forward. We believe we have unlocked rights that had been previously encumbered, and we have a ton of growth there. And then beauty and grooming, whether or not you agree with it, we have been an arbitrator of beauty for the past 67 years, and we believe there's a ton of growth. In fact, in China, men's grooming is one of the leading and fastest growing categories. We're not into it today, but we plan on entering it moving forward. Just a little bit about sexual wellness. Again, $240 billion industry today, projected to grow to $400 billion by 2024. This is anything from lingerie to bedroom accessories. It is a category that has become mainstream today everywhere in the world, whether you're in China or the United States. This is Gwyneth Paltrow going on the Ellen Show and talking about her favorite vibrator. This is CVS and Walmart entering these categories with more and more shelf space. It's something that we believe we can own a significant percentage of. And then I just want to briefly talk about M&A and my core skill set. We see unbelievable opportunities moving forward, and we have a very robust pipeline to buy businesses specifically in the sexual wellness space. Again, when we think about Playboy and that global infrastructure, and what attracted me to take over the CEO role and really build this, was the ability to bolt on or to add on businesses, brands, and new products to that Playboy infrastructure on a global basis. So we could buy a brand domestically that would make sense to the consumer, but they wouldn't really have the capability of expanding internationally. That product to us could make sense to the consumer internationally with the Playboy brand on it. And because of that infrastructure we have in Asia and other parts of the world, we're able to realize real synergies by buying those brands. We also have $180 million of NOLs, as I mentioned before, to shelter either our organic income or our inorganic income. And so when we look to that 2025 projection that we talked about, $100 million of EBITDA, we believe we can accelerate our path to that $100 million much quicker through an inorganic strategy. Just really quickly summarizing some of the products so you get a feel for this company today. It's really a consumer product company at the end of the day. These are a few of our sexual wellness products that are in market today: our condoms, our intimacy wipes, our recent launch of our CBD owned and operated business that we launched in the fourth quarter of 2020. A few of the collaborations, again, I talked about the packs on misguided businesses increasing almost 15x over the last 2 years. On Tmall, Alibaba, JD in China, where it's Supreme. We're actually Supreme's longest standing collab partner, Urban Outfitters, and very excited by Playboy Labs, which is something that we launched last year, really going after the streetwear as the drop culture business. A few of our gaming properties, we have a social club or a poker room opening in Houston this year. We have partnerships with Micro Gaming, as well as Scientific Games. We have a casino in London. That casino in London is in partnership with Caesars. That was shut down for a large portion of last year because of COVID. We also saw an impact to our micro gaming business last year, but through the 3 quarters of last year, we were actually up 19% and still left a lot of money on the table, which we expect to recoup this year. And then in the bottom right, you see a furniture collection that we have launched on Wayfair. Again, this really speaks to the uniqueness of this brand and that the growth potential is unlimited. It's not a brand that is just in one category. This brand is a lot of singles and doubles, and that's what makes up our revenue. And I think it's also why we did so well last year. When I look at it, is that we are not dependent upon one revenue stream. We have multiple different revenue streams. And so given that and our geographic diversity of our revenue, we were able to really weather the COVID storm. Again, there was an impact to the business, but we expect that we will. Just really quickly also, the company has a rich 67-year history fighting for personal freedoms, freedom of expression, freedom of sexuality. We continue to do that today. Some of the causes that we have supported over the last year include the ACLU, the Trevor Project, BLM, and the Last Prisoner Project. And then just recapping before we open it to questions, again, this is one of the largest brands in the world. The potential here is really unlimited. We can be in the sexual wellness category. We can do products in ED, sex toys, lingerie, etc. We can have products in style and apparel. It's what truly attracted me to this brand was the absolute global scale of it and the ability, because of the capital structure that I've inherited and with this capital moving forward, to truly accelerate that growth. We have $400 million of forward booked, highly visible contracted minimum guarantees. We have $180 million of NOLs. And we have a management team and a shareholder base that is commonly aligned. Again, insiders and existing investors will own 66% of the company on a fully diluted basis, assuming that we are successful in the shareholder vote and keeping the money in trust. And the existing investors and management have signed a 1-year lockup. And with that, Nick, would love to open it up to questions.
Great. Thank you very much for the presentation. I'd like to remind everyone that you can submit questions to the Q&A by clicking the Q&A button at the bottom of your Zoom screen there. I am Nicholas Clayton. I'm a writer and analyst at SPAC Insider, and will be manning the questions and engaging with all of you. And actually, our first question that did come in touched upon what you were talking about towards the end of your presentation there in terms of the various new opportunities in gaming. Someone asks, do you have plans for VR casino gaming? Put on a headset and play real money casino games with friends or with potentially with celebrities from Twitch or OnlyFans? And is there any potential for Playboy branded joints with either CBD or THC or some combination in the future?
Great. So multiple questions there. Let me talk about the gaming sector first. So one of the things that's a little bit misleading about our historical numbers when you look at it is the actual future business tied to consumer products has actually been growing at a double-digit rate while we've been shutting down the legacy media businesses at the same time. So the decline in Playboy TV, the magazine, et cetera, which are behind us today. At the same time, we've actually also probably terminated as many, if not more, deals than we've signed moving forward. And that was to really create a ton of white space. So rights had previously been encumbered that we have now taken back to really give us that room to grow and achieve the organic numbers that we're projecting. And so gaming is a perfect example. We have real money gaming today with micro gaming overseas, but we have the ability domestically and in other parts of the world to relicense those categories. And also on the VR or the virtual worlds, when you think about the Unreal platform, you think about what Travis Scott did with Epic this past summer in Fortnite, reaching 27 million people doing a live concert. We truly believe that customers should experience this brand on a global basis, and our ability to do that through a digital format. Again, I'm not promising we're going to do it, but it's something that we were looking at. Being able to do that through a virtual world is something that's extremely interesting to us, where you can create social games and other games. So again, real money gaming is licensed by jurisdiction. We have partnerships today with micro gaming, with scientific games, et cetera, and we are looking to rapidly expand that moving forward. As far as cannabis, we have launched 3 CBD SKUs in the 4th quarter of last year, a bath bomb, an intimacy gel, and an arousal spray. We have 4 more products that are in development that will be launching in 2021. We also believe that internationally, there's a real opportunity to expand our CBD portfolio and geography. And then on the THC side, this brand has fought for the legalization of marijuana for the past 40 years domestically. We had actually planned on launching THC products in 2020. We pulled those back because of the SPAC process and obviously worried about November and what was going to happen with the election, and would THC be legalized on a federal basis with banking law reform. What I can tell you is to the extent it is legalized on a federal basis and there's banking law reform, we plan on launching THC products moving forward. We've done a ton of consumer research around this and believe there's a real opportunity and that the brand resonates in the THC space with consumers all across the country.
Great. And we have several questions already. A couple already kind of looking at the company's revenue and revenue growth and trying to strip out the Yandy acquisition and the proceeds from its continued business from the rest of the group. What percentage of Yandy's its revenues kind of make up the total pie, and where do you expect the 22% growth to be coming from in the next 12 months that you're projecting?
Sure. So we don't break out Yandy separately anymore, and this is really the go-forward strategy as we continue to buy other companies. And let me give you a reason why. Yandy today is fully integrated into Playboy or the PLBY group, as will future acquisitions that we make sure we be successful in those acquisitions. Yandy today is selling Playboy product. In fact, we've had unbelievable success selling Playboy lingerie through 2 drops on Yandy. in 2020, and actually in 2021 we've begun that. And Playboy is selling Yandy products. So again, the way we think about that is having multiple different front ends that reach different demographics from a consumer perspective on a D2C basis with one common back end. And so what we were able to buy with Yandy was a lingerie business that we knew had already resonated with Playboy consumers. And we were able to pick up, over 2 million emails and multiple hundreds of thousands of customers that we are now monetizing, not only through Yandy, but also through Playboy.
Okay, great. And you touched upon M&A and some of the different product lines there. We do have a question about that, which is what kind of products / companies do you look for, and what kind of multiples do you anticipate when acquiring those companies? I imagine that varies quite a bit, from sector to sector.
Yeah, and Nick, the other thing I think the question was sort of organic growth. I think that, and I'll go back and then talk about M&A. I just quickly on the historical organic growth. Again, our licensing business, which we continue to see unbelievable opportunities on a global basis to continue to expand that, in India, in Brazil, and other parts of the world. We think that's going to more than double. We have been growing that business at a double-digit CAGR for the past few years while we were shutting down the business. From an M&A perspective, we're looking at a few things. We're looking at other distribution capabilities, both e-com and potentially specialty retail, that would make sense and really give us the ability not only to introduce our owned and operated products, but also to test, bringing other customers into that fray. One of the things that we have built internally is a data science practice, and what we're seeing is the ability to sell multiple different products to the same customer. And so we're able to do that at an enhanced margin because we're doing it at a reduced CAC. So I can take that Yandy customer and sell them Playboy CBD or other Playboy products. I already own that customer. I don't have a new CAC associated with that. So we're looking at brands that make sense. Again, we do not believe in our signal really moving to the PLBY group moving forward is that Playboy should be on every product. We really think about Playboy as the pleasure lifestyle guide, really giving something we talk about internally, really enabling pleasure in your lives. But it wouldn't make sense to the consumer, and that's what's most important first, is what makes sense to the consumer. And so we're looking at brands that make sense, but that we might be able to exploit internationally with the Playboy brand. We're looking at distribution capabilities. As far as the multiples, I'll say I'm cheap by nature. I've had a very good track record, I believe, in private equity, and I look to continue that here. In the sexual wellness space specifically, which is really the first area that we are targeting acquisitions in, we're able to buy businesses somewhere between 4 and 8 times cash flow. Again, it depends on the type of business, but we believe those are all accretive to our shareholders moving forward. And obviously we're buying those businesses, so me, pre-synergy. So we believe that all the synergies should accrue to the benefit of our shareholders, not to the sellers.
Okay, great. And another question is the 400 million in contracted royalty and license revenues, is this a 100% margin business, or are there any costs that you incur to generate that? So we believe that brands are living and growing organisms, and it's something that requires constant reinvestment into the brand. Again, the 400 million is just minimum guarantees on existing deals at the time we did the analysis. And so what we're investing in today, again, our content business has moved from that of selling subscription products or advertising to that of selling consumer products today. And I think we've effectively done that. But again, it's hard to say, how do you allocate those costs against it? And so the way we think about those cash flows, it's roughly an 80% margin on a gross margin basis. It does not take into account the costs that we keep at corporate, that we spend on constantly revitalizing and reinvigorating the brand. And I think we've seen unbelievable traction. Rachel's on the phone, our chief brand officer, as well as head of strategy. What she and her team have done over the last 3 years is unbelievable. We've seen our female audience grow 70%. We've seen the average age of our organic audience drop by over 10 years, where 90% of our audience today is under the age of 40. We look at the Kylie Jenners, the Travis Scotts, the Lizzos, the Bad Bunnies, the influencers that we don't pay that have come to work with us because what this brand represents. All of that leads us to believe there's unbelievable growth moving forward.
And so again, it's hard to say how do you expense that, or how do you allocate that. Again, the most important thing is that the brand continues to stay extremely strong. That increases the ability to drive organic growth moving forward. If you look at the streetwear business, we have gained a whole new customer base, in that 14 to 24-year-old today that are wearing the streetwear. You look at our Packs on the Misguided businesses have increased almost 15x. You look at our collabs with Steve Aoki and others that we've launched through Playboy Labs. Again, that all speaks to the brand and the strength of the brand. It also gives us new IP like Playboy Labs that we can exploit internationally through a licensing model.
Great, and I wanted to throw it to Ying as well, just to get sort of the SPAC perspective on this deal and on the company as well. How many different companies did you look at before landing on Playboy, and why ultimately was Playboy the choice from your perspective?
Absolutely. So we look at about 15 companies, so a fairly good amount. Of course, we zoom in to a slightly few, and within that subset, we really realize Playboy is a great value, of course, for various reasons. But the major ones, of course, first off, is the brand, right? It is one of the most iconic brands in the entire world. And then adding on top of that, the management has been superb in basically having this transition narrative from really a print media to a consumer products business. And that has seen tremendous growth over the years, and will be on a very almost exponential type of a growth trajectory into the future, provided if we can execute. And also, just in terms of geographic, it's truly global, right? Given my Chinese background, I grew up seeing a lot of Playboy products in China. So that global synergy, we believe, will be able to persist into the future and just further adding to the whole attractiveness. And also, we were able to get a pretty good valuation. So I think that will really serve us, our shareholders well, moving forward.
Great. And talking about sort of the global presence, we did have a question about that as well. And what is your strategy to conquer the low presence of the brand in Europe and Latin America?
Sure. So we have really cleaned up those territories over the last 3 years. Again, I mentioned earlier, we've probably terminated as many, if not more, deals than we have signed, largely because one of the things that Rachel came in, really would love Rachel to talk for a few minutes too, but Rachel's background is big brands. She was the chief digital officer at National Geographic. I actually found her through a podcast that I listened to with Kara Swisher when they were talking about revitalizing this unbelievable brand in National Geographic. She had been at Rovio working at Angry Birds, and then multiple different roles at Fox. But internationally, we've cleaned up territories, we've cleaned up product categories, we've created a ton of white space moving forward to accelerate the growth. Europe is obviously a place where we have a casino, we've had multiple products. Again, from a business model perspective, we're very interested in the direct-to-consumer business. We believe that licensing is an unbelievable cash flow, gives us a ton of visibility moving forward, but it's also an inefficient model moving forward when you think about a D2C environment that COVID has really accelerated. And specifically when you license your brand out to third parties, and again, Disney's the largest licensed brand, that you'd like to use them as an example. When you walk into Disney or to a Disney store, you don't know if you're buying licensed product or owned and operated product. It's Disney product. And we think in a D2C environment, if we become the distribution hub for our products, given that we know we've acquired a customer, they are a fan of Playboy, we can sell them multiple different products. Again, it doesn't necessarily even have to be Playboy branded, but it could be part of the 4 categories that we're in that pleasure lifestyle. That's key, and we think we can increase the lifetime value at a reduced CAC for that. Rachel, maybe if you want to just speak for 2 minutes on the strength of the brand, what you've done, largely hiring a female team, telling the story from a female point of view, which I think has really resonated with Gen Z. and embracing those historical personal freedoms that we fought for.
Sure. Thanks, Ben. When I joined the company, the first thing that we did was really look into its DNA to understand how it could resonate and how we could reintroduce it to consumers today. And this was a couple of years ago. And what I personally was most excited about was really digging in and seeing at its core, Playboy is a lifestyle brand. The first consumer product that the company made was cufflinks, which we think symbolizes so well, people wanting to wear this brand on their sleeve. It's an identity-based brand that helps you express that you're unapologetic about what you believe in and that you are really embracing living your life to its fullest. There were clubs introduced around this brand in 1960, allowing people to actually step into the world of Playboy. So we really leaned into that. The changes that we focused on making were really about expanding our addressable market, expanding who that pleasure lifestyle is for. What was originally created as a men's magazine saw enormous resonance with a female audience as well, but we weren't necessarily creating the right products and services for women. So what we started doing was really focused on working with the biggest content creators on the planet, working with the Kylie Jenners and the Lizzos and the Travis Scotts and Bad Bunnies, creating content with them, turning that into formats where people are actually engaging today. So taking it out of a print magazine and turning it into things like the Playboy Advisor digital series. We created a Playhouse, which is a live experiential activation that people could step into and experience the brand for themselves. And then most importantly, we're creating products that really resonate with today's consumer. Doing that through collaborations, as Ben talked about. We have a really strong history with collaborations in the streetwear space. One of Supreme's longest running partners with Misguided, PacSun, really appealing to that hypebeast consumer. As well as creating products that demonstrate to people how they can weave pleasure into their lives. So the recent launch of our new sexual wellness line, that our CBD-based products has been described, that we launched alongside a series of classes to help people explore the pleasure gap and the orgasm gap. We had over 3,000 signups within a couple of days for those series of classes. So what we've really been focused on is going into the core DNA of what Playboy stands for to create a culture where all people can pursue pleasure, and then bringing that to life through the right products and services, the right partnerships, the right creators to make that resonate in people's lives today, both here domestically and globally.
Yeah, and what I'll add to that again is, we've grown our female audience over 70%. Over 40% of our e-commerce customers today are women. And so again, it speaks to the breadth of this brand, not only the number of product categories the company has played in historically, which I really, in my mind, makes this brand priceless, right? You can go spend billions and billions of dollars trying to recreate what we have on a global basis, and I would challenge you that you couldn't do it. And so we have to execute as a team. We're fully aware of that, but that growth potential, long term is really unlimited into the type of product categories we can play in and the geographies we can play in, given the 100% unaided awareness we have on a global basis.
Great, and to that point, moving forward, one of the questions here is that it looks like the company should be able to eliminate debt through in 12 to 24 months. What is your take on capital allocation? Spend whatever you can to acquire brands and companies, share buybacks. How do those all play in?
Look, I'm motivated by one thing, which is enhancing the enterprise value and is making as much money for our investors. And I've done that through the 25 years of my career in private equity. As far as capital, I will tell you, I hate debt. As a private equity individual or principal, I loved it. But as an operator, I hate it. And yes, we really are lucky that we benefit from an unbelievable free cash flow conversion. So again, as a company, less than $1 million of CapEx, $180 million in tax shelter or NOLs moving forward. And so when you look at that as an EBITDA conversion to free cash flow, our goal would be to continue to delever the company. We will do things that make the most sense. We will structure M&A deals that make the most sense and are most accretive for our investors. And that's what I'm focused on. And so from a capital allocation, we're not making huge bets going forward. Again, we've had no capital to run this company. We start every year historically with almost $18 million of debt service. And so what I'm really excited about is we know the growth is there. We know our audience wants more from us and our consumer wants more from us. And what I'm excited to do is just have a little bit of money to really accelerate our organic growth moving forward. And I am confident that we can do that. And then we obviously have the inorganic side as well. So our goal would be to continue to delever the company moving forward. Again, I want to take advantage of opportunities when they present themselves. I'm very opportunistic in how I think about things. And to the extent we can buy the right companies that make sense for our organization and what we're trying to build long term at the right multiples, we'll do that. The other big advantage we have is that licensing business, that revenue stream. We know where consumers are spending money against the brand and on what products. And so our ability to leverage that data that we have to then make smart capital allocations moving forward on new product launches is really a unique competitive advantage. We're not trying to launch a product and say, well, will the consumer buy it? We already have a historical 67 years of we know what products consumers buy and where they buy them, and then we can look at that empirical data in our licensing business and those sales reports to really make smart bets moving forward as well.
Great. And one question here is just kind of looking at some of those drivers for both revenue and operating leverage, and finding sweet spots, I suppose. It seems like the 2020 adjusted EBITDA expansion came from increased licensing revenue, but guidance was that there was a business model transition from licensing to owned and operated. How do you? It sounds like you mentioned in the presentation that that some of those decisions are taken by sector basis. But what is your approach now?
So I would think about the business model transition as not as necessarily a transition as much as an expansion. And so again, we're not taking licensing deals and terminating them per se just to run those categories, right? We have terminated a ton of deals. We've terminated those deals to clean up markets, to clean up product categories, because we didn't feel long-term in this digital world those were the right partners moving forward. Licensing will continue to grow. As I said earlier, we're anticipating licensing to more than double from where it is today. And we know that we have the runway, both on a product basis and a geographic basis, to accomplish that. D2C is largely a North America strategy today. Again, the brand, we did not license the brand historically. We had done JVs and partnerships and collabs in North America, but we, in fact, 5 years ago had terminated most of our licensing deals in North America in order to sort of rebrand and reintroduce the brand. And so this is all future growth. Again, it's more of an expansion than transition. We love licensing as a revenue stream, and we plan on growing that as a revenue stream in geographies or product categories that we do not have internal expertise to operate ourselves. But domestically, we believe there's an unbelievable opportunity that the US has historically trailed other parts in the world in its adoption of e-commerce as a percentage of retail spend. Obviously, we've all seen that with COVID, that has increased. We believe that is the future. We also believe as a brand, and again, I mentioned the Disney thing example, is that we should become the hub that sells our products. And so for the first time in the company's history, and we've just relaunched our e-commerce site, we're selling licensed product on our site. Now, intuitively, you would think, well, why didn't you ever sell licensed product historically on your site? Well, the company had never done that. And so we now sell packs on a misguided product on our site that gives us the ability to capture that customer and then drive lifetime value by offering them other products and services.
And one more kind of category question is there any interest in opening nightclubs to perpetuate the brand and capture the post-COVID group experiences that we expect to be coming back at some point?
I believe live experiences should be part of our business model moving forward. Again, we're opening a casino or poker room in Texas later this year. That was something that got pushed out from last year because of COVID. I mentioned also, ability to build on like the Unreal platform, Epic Games, Unreal platform, et cetera. we want to make sure that when we open Playboy clubs, which we will do at some point, that we're creating the right experiences. One of the things that Rachel led in 2019 was the opening of these playhouses, where we were able to actually create unbelievable environments for Gen Z, tied to music and art, and really having lectures on, we had a make your own vibrator workshop, which sold out in a matter of minutes for the two playhouses we did. And so we believe long-term, we should have live experiences, but it needs to be done in a thoughtful way and with the right partner moving forward. And so that's what we're focused on. Again, as a brand, and one of the most valuable brands, in my opinion, in the world, we're only as good as our weakest partner. And so we have to make sure that when we move forward with partners in the hospitality sector, that we're picking the right properties, the right partners, and that we have the right vibe for the experience.
The other thing I'll just add on that is the opportunity for experiential retail, and particularly in the sexual wellness space, where we see consumers really wanting to interact with expert retail associates, wanting to participate in classes that a retail environment can host, and where in the sexual wellness space in particular, discovery is something that consumers are looking for. So the opportunity to enter into an environment and learn more about the products and services is something that we are going to take very seriously going forward.
Yeah, Rachel, I think that's a great point. We believe that there's a real opportunity for experiential retail, and it's something that we're looking to either acquire or hire for. That the brand is best when people can experience it. Obviously, D2C is our focus domestically, but D2C can be coupled, as we've seen with Apple and a whole host of other massive brands, with an experiential retail concept as well.
Great, and we have a couple of numbers questions here.
Sure.
One being, what will earnings per share look like in 2021 to 2025 based on your projections? And in terms of cash conversion, what should the cash conversion look like as compared to EBITDA?
So on an earnings per share basis, I just want to be careful, and I apologize. We have not historically publicly released that data. What we've released is just our EBITDA data. And so as much as I want to share that with you today, we can't answer that. But I think what you can look at, is the number of shares outstanding, the EBITDA. You can look at that in the third quarter of 2020, we did turn a profit per share. And I would encourage you to look at that. We do believe that we can enhance margins moving forward, just based on the infrastructure we have and the synergies that we can realize in that. On the free cash flow conversion, again, we haven't given 100% specific guidance. What I can tell you is this year in 2021, we are forecasting less than $1 million of CapEx. We have $180 million of NOLs, and we are currently in the process of exploring refinancing our debt. We believe with the new cash on our balance sheet, we can significantly reduce our cost of capital. And so if you add that all up, depending on how much we decide to amortize on an annual basis with our debt and what the terms are of that refi, I would assume it's in that 70 to 80% range of EBITDA to free cash flow conversion. But again, as a team, we want to accelerate our growth. And so we believe there's that much opportunity in front of us. And so it's always going to be that balance of accelerating growth and cash flow. As a private equity principal, historically, I love cash flow, but I also want to take advantage of the opportunities that we've been missing to really accelerate our growth, because we've had a lack of capital historically.
Okay, great. And there's a question here, if I think I understand it correctly, is could you expand upon the acceleration of the revitalized consumer product businesses versus acceleration process, the legacy media business, and looking for percentages? I think they mean it just in terms of, what, in terms of the revenue mix right now, what is the legacy portion of that versus all the new stuff?
What's left on the legacy media side is very small. It's, I think, less than a handful of international publications. Again, when I took over as CEO, we had 26 international publications. And we've just been winding those down and letting those deals expire. Obviously, we are very cash strapped, and so we didn't have the money to go out and terminate those. So we have a few left. Again, I believe it's less than $100,000 in revenue. Playboy TV still exists. It's in its wind down phase as well. And so again, from a total revenue perspective or EBITDA perspective, the real growth and the bulk of our revenue moving forward, again, 90+% is all in consumer products, and that will continue to accelerate. And then historically, we've talked about this, that the historical numbers, and I think there was a question on this, are a little bit misleading from a total perspective, because you really have to look at the detail behind it. What we have been seeing is that our consumer product business, again, largely licensed until the end of last year, has been growing at a double-digit CAGR, offsetting the declines and the shutdown of our legacy media businesses. And obviously, everyone knows in March of 2020, we've been winding down the magazine for years, for the previous 2 years, but we officially shut down the domestic magazine in March of 2020.
Okay, great. And I just wanted to give all of our viewers the notice we are under 10 minutes left in the webinar, about 8 minutes left. So there is still perhaps time to get another last minute question or two, but just before then, can you talk a little bit about what your China strategy is beyond the licensing business and men's fashion, and how you're going to be transitioning those categories?
Sure. So in China, we've been in China for 25 years, one of the largest men's fashion brands in China. Our product categories include, men's fashion, accessories, handbags. We actually have an outdoor wear line called Playboy Physical in China as well that does extremely well. Big shoe business in China. We believe there's a real opportunity in men's grooming, which is one of the fastest growing consumer product categories in China. We believe there is an opportunity with women's apparel in China. So we had an unbelievable success. 11/11 is their big sales day, e-com sales day in China. We launched 2 collaborations this past 11/11 that were unbelievable for women's apparel. We think we can build a women's apparel business in China, hopefully as large as our men's apparel business. And then there's other opportunities down the road as we think about these category expansions or product expansions that have not been licensed. Do we do that ourselves on a D2C basis, or do we do that through partners? And that's something that we are actively exploring today. And then there's other products. Sexual wellness is a huge category in China. It is growing everywhere in Asia. And that is a category that we might decide to do on a JV or an owned and operated basis moving forward. Historically, our business in China is all men's fashion. It's not sexual wellness. We know the brand plays based on our consumer research in China, in India, in sexual wellness. And it's something that we are actively looking at right now.
And there's an interesting question that came on just on that subject, in that after you acquire enough sexual wellness products, could there be a D2C subscription service possibility?
So I'll tell you personally, again, I love predictability in my revenue. It's one of the things I love about our licensing business as a revenue stream, not a business model, is, I've already received for 2021 all of my cash on a minimum guarantee basis out of China that would be recognized in that period, right? So it's almost a negative working capital situation. I think D2C, again, for us on the sexual wellness side, and specifically subscription side, we believe the sexual wellness business lends itself to a subscription model. Again, not every product category in that lends itself to a subscription model, but we believe a lot of them do, and it's something that is part of our plans moving forward.
Great. And there's also a question that maybe both you and Seeing can jump on, and just in terms of, what do you see as being the specific value that Mountain Crest brings to the company moving forward?
Yeah, so again, I talked about when I joined Playboy and left private equity, I wanted to actually do what I had done in private equity, but to do it in a holding company format. And there was no better brand to do it in or with than Playboy, just given its ability to leverage that global infrastructure and awareness we have. And so Mountain Crest was, a SPAC. What was truly attractive to Mountain Crest was not only Su Ying's relationships in China, which we think will enhance our business moving forward. But it's also its capital structure. And so having, given that Mountain Crest has no warrants outstanding, it only has 1/10 of a right, and given that no one is selling, I personally, as well as the management team, own a significant portion of the company. None of us are selling. We're all here to build this to multiples of where we are today. We're very sensitive to the amount of dilution that we are taking up front. So, the most we wanted to take right now is we have the $50 million pipe. Hopefully we'll be successful in retaining the $58 million in trust, which net of deal costs will leave us with over $100 million of growth capital or unrestricted cash on our balance sheet. My intro to SPACs actually started about 3.5 years ago, with Harry Sloan and Jess Sagansky from the Double Eagle SPACs that actually approached me and wanted to roll a few of my portfolio companies at the time when I was in private equity into what was the Double Eagle SPAC at the time. And then unfortunately, Blackstone came in and bought the largest company for all cash in that transaction, and then the SPAC wouldn't work. But the goal all along when I stepped into Playboy was to go public, either directly or through a SPAC. A SPAC is a much more efficient process, and a much more efficient process for us to actually be able to go out and tell this new Playboy story. People have a misconception of what Playboy is. And Playboy today is a consumer product company. Most people think about it as a media company. We are not a media company. And then really our signal, rebranding the company as a public company to PLBY Group. P&L really stand for Pleasure and Leisure, not Playboy, of which Playboy will be our cornerstone brand day one, but we look to add to that very quickly.
Yeah, it's always great to hear from Ben on our value add instead of me speaking about it. But as Ben mentioned, right, so our structure is pretty unique, especially in the SPAC our size. So that really gave us a very, very non-dilutive structure, which is beneficial to actually all shareholders, including, of course, Playboy's existing shareholders. And I'm joining the board. So like Ben alluded to, there could be China opportunities. Of course, we don't have that anything definitive, right? It's still just Playboy has the intention of expanding markets in APAC region. But should that opportunity arise, I'm fully willing to bring my relationship in China on board.
Great. And there's only a little bit of time left, and I want to give everybody a chance to some closing remarks. But one last question that was interesting that came in was, do you have any kind of direct comparables in the brand space that have executed a similar strategy as this, or it's Playboy itself kind of uncomparable?
Look, I think there are very few brands, in my opinion, and Rachel, I don't know yours, but very few brands that have the breadth of areas that it can play in as Playboy. I can't really think of many that can play in as many different categories as we can. Now we have to be careful in how we do that, and we have to execute and be very focused. But I think about companies like Hims and Romans, for example. Playboy could easily play in those categories. Now we might not want to do that because of the customer acquisition costs, and it might not be a core product, but it might be an ancillary product that we add on to our sexual wellness portfolio, partnering with someone in the telemedicine space versus developing it. The thing I'm concerned about in that space is the customer acquisition costs. If you're only a telemedicine business, our ability is that this brand plays across this pleasure lifestyle, and the ability to then diversify across multiple different product categories is unique. I think that internally as a management team, we talk a lot about Nike. Now, obviously, all of us would love to emulate to Nike's success, but I believe that our strategy, when I go back 3 years ago, that we set on, is very similar to what Nike's done in the last 12 months, which is one of the largest brands in the world, very focused on D2C, and they've had unbelievable success doing that. And the other one we talk about a lot internally is Disney, another company, phenomenal management, would love to emulate towards. But I don't know a brand that has as much diversity and sort of runway ahead of itself as Playboy on a global basis. It can play in multiple different categories. And then our ability to create sub-brands like the Playmates that Rachel's working on right now, reintroducing that as a consumer product category, like Playboy Labs, Playboy Streetwear, et cetera. That really is encouraging moving forward from a growth potential on a global basis.
Great. Well, unfortunately, we have run to the end of our time. That we're just past 1, but I'd like to thank all of our viewers that have submitted questions and joined here, and especially thank both Playboy and Mountain Crest for taking part in this webinar.
Thanks, Nick.
Thank you.
Thanks so much.